We're now very happy to have Henry Montag, who is director of the Tolley Center East, and he also is an incredible expert on life insurance. And in fact, he's been referred to as, and I quote, one of today's best brains in life insurance. And I'm going to turn the program over to you, Henry.
Well, thank you. First of all, I'd like to just thank Barry Chase for initiating this, for setting this up, and for the invitation. And I'd also like to thank the attendees for being here, for listening, and very significantly thank Andrea for setting this up for me in terms of some of the issues about life insurance and some of the areas that life insurance can absolutely apply. Again, I'm going to be talking about life insurance as a generally accepted vehicle to be able to offset the additional future liability as a result of the lost stretch opportunities that Andrea just described as a result of the Secure Act. Also going to be talking about how life insurance is expiring prematurely in normal times and how the COVID-19 effect on interest rates and the stock market has severely and significantly impacted both the guaranteed as well as the non-guaranteed various types of life insurances. I'll be discussing the various types of life insurances, giving you a little bit of an overview just to explain what the difference might be between a universal policy or a variable policy or an index or the two other policies that I'll be discussing. Also discussing the fact that the COVID-19 experience has caused more life insurance policies to expire more rapidly than ever before. I'm also going to be touching on a quick update on the business interruption insurance. And lastly, I'll be talking about the several of the options that people have in terms of dealing with some of the problems. And one of the most significant is the subject of a life settlement to be able to provide some current cash needs. Okay, so let me start off with the idea that life insurance is used to offset the future tax liabilities as Andrea just described them. Government has taken away the ability of stretching the IRAs, for 20, 30, 40, 50 years. There's some individuals who were able to stretch it into 2 generations. So all of a sudden, instead of the beneficiary having virtually no tax liabilities, the beneficiaries now will have a significant tax liability at the end of a 10-year period. As I said, life insurance is at this point, is generally accepted good solution to be able to pay their beneficiaries future tax liabilities. And different policies provide different options and different benefits. Life insurance costs of insurance. Now, because of the fact that unfortunately more people are going to and have passed on as a result of COVID, the insurance industry looks to protect themselves just like any business would. And one of the things that they do is increase the internal costs of insurance. Now, if that's not bad enough, in addition to the fact that they will be increasing the costs, let's take a look and see what's happened to interest rates. Government can't drop many more. They basically dropped it to 0.25% or zero interest rates. Now, life insurance companies are really nothing more than banks, and they make their money by the interest that they earn on bond funds and the interest that they earn on lending their money out. Now, just take that for a moment and just realize that if the interest rates are zero, how that affects their earnings ability. Again, insurance companies are businesses and they have to fight back and do something. And what they do is they not only increase their costs that they charge their client, but they're also going to have to do something to make up for their lost income. Now, as I say, COVID-19 worsens the situation because, as we'll soon see with some of the various insurance products that rely on the stock market, yes, for the most part, the stock market has come back, but there are still many sectors within the stock market that are significantly undervalued and underperforming to this very day. I don't have to mention them: the airlines, the energy sectors, various other financial institutions. And again, this hurts. So the point that I'm making is that life insurance policies have to be actively managed to be able to be maintained. And also talk a little bit about the fact that the best type of life insurance to be used to offset these future tax liabilities is a second to die policy, which pays exactly what it's needed at the death of the second individual. So let's talk about the workhorse of the insurance industry. This is the insurance that the majority of individuals have today, and the majority of product that is going to be on the marketplace for the foreseeable future, in my opinion. The non-guaranteed universal life insurance. The coverage is based on interest rates that change. And as we said, interest rates today are significantly lower than they were last year and significantly lower than they were several years ago. This has an ongoing compounding impact on individuals that might consider using life insurance that they've already purchased to make up for these new future tax liabilities. And the problem is that people assume that interest rates just remain the same. Now, for those of you that are on the program with us, if you think back to what interest rates were in the 90s, or when interest rates were in the early 2000s, interest rates have gone one direction over the last 20, 25 plus years, straight down. And many of these policies, as we said, were purchased years ago when interest rates were significantly higher. So as rates decrease, the duration of the coverage decreases as well. And the insureds are not aware of this fact. And as a result, they pay the same premium as when rates were higher. And that impacts the duration of the existing life insurance. As a result, a non-guaranteed universal life insurance is not an accepted pandemic type of vehicle suitable for stretch IRAs. For the stretch offset is what I meant to say. And again, let me just go into that for a moment. Why do non-guaranteed universal life policies lapse? Because the insurance company bills the premium and they don't change the premium that they may have billed you 2 years ago or 3 years ago or 5 years ago when rates were significantly higher. Death benefit remains the same. Again, it's not the insurance company's job to say, Mr. Client, you're paying the same premium that you paid 5 years ago and your death benefit remains the same. Perhaps you should reduce your death benefit. That's not their job. So if you're paying the same premium and you have the same death benefit, the only variable, the only place, it's like when you squeeze a balloon, if you squeeze in one area, it's got to come out someplace else. And the only variable is in the length or the duration of coverage. So as a result, the duration of coverage is reduced to the lower rate. And what that means is that a policy that you may have thought might last into, say, age 90 or 95, you might find those policies now lasting until age 80 or age 85. Now, as I say, the trustees or the owners of those policies should have increased the premiums. But who are those owners? They're basically the children or spouses or sisters or brothers of the individual insured. And they really didn't get a lesson when they said, yeah, sure, I'll become the owner or I'll become the trustee. It's a nice honor, but that didn't come with a instruction booklet. And the insured has certainly not stepped up and said, oh, by the way, this is what you should be doing in terms of managing my policies. So here we are with universal policies that are non-guaranteed, consisting of anywhere between 45 and 50% of existing coverage. And as I say, the insurer, the insurance company, benefits when coverage expires early, whether that happens because the client says, I can't afford to pay the additional increases that I'm now going to need, that I should have been paying over all these years, or whether the insurance just said, screw you, insurance company, I'm not going to pay you anymore. Either way, the insurance company stands up and greatly applauds every time that one of their policies lapse, because it means that the insurance company gets to keep all of the previous premiums. They fall right down to the bottom line, and they will never have to pay out a death benefit. Shouldn't the insurance company have told me? Well, this is a real redacted page 3 of a 6-page report. And if you look all the way in the bottom, it says important notice. And if you look a little closer, it says changes in interest rates may impact the insurance coverage and cash value objective of your policy. You may need to readjust your payments. Now, if this were really an important notice, shouldn't this have been on page 1 in big black or red letters? That notice on the bottom where it says important notice, that's not the insurance company, that's mine. All the insurance company has is in 0.2 font. It's telling you on bottom of page 3 of a 6-page report that this is an important notice. They don't really care whether or not you read this or not. It's in their best interest if you don't. This happened to have been a reporter, senior reporter for Wall Street Journal. She's actually the insurance, money, and investment reporter. And it just very briefly says, I've written multiple stories over the past 5 years in the Wall Street Journal about the impact of low interest rates on universal policies. The problem is exacerbated because many people underfund their policies, often unaware of how important it was to keep them well funded. Of the many consumers I've interviewed, most don't understand how the policies actually work. Many have long since lost contact with their sales agent. I see many consumers responding to these stories as the problem is so recurring. It's a problem. Interesting quote from the General Counsel for the Insurance Marketplace Standards Association. He's basically saying that while insurers have not publicized the issue, there is a growing concern of the industry about lapsing universal life policies. I assure you, it's not a great concern for the insurance industry. It's a great concern for the consumers. Now, on the other end of the non-guaranteed spectrum is something called the Guaranteed Universal Life Insurance Policy. As of 2003, after numerous complaints, the insurance industry finally decided to come out with a guaranteed universal. Now, a universal policy, as we said earlier, is based on interest rates. They don't care about the stock market. They don't care about the pandemics or wars or anything else. They are guaranteed. Guaranteed universal premium is sufficient to be able to provide coverage for a specific time period. In other words, if you say, I'm purchasing this guaranteed universal policy and I want it to last until age, I'll make up a number, until age 95, the broker will calculate exactly how much premium must be paid to maintain the specific death benefit that was selected for a particular specific period of time, and that premium will not change. It's the least expensive permanent coverage provided. It doesn't accumulate assets or cash value, but it provides maximum guaranteed coverage. As a result, this is a perfect vehicle to use for the pandemics, and it is suitable for the stretch offset planning. And that's an important point because, as we'll soon find out, there are several other types of insurance policies, and not all of them are suitable for this particular strategy. Next is an indexed universal policy. An indexed universal policy works on you will get X percent of any increase in a particular sector of the stock market. Now, because you're only getting a percentage of it, you're giving up the lion's share. You might only get 10% or 12% of the increases, but in exchange for giving up the 100% of the return, if the market goes down, there's a floor on your losses. Anyone holding an indexed universal policy, if the stock market, as it did 4 or 5 months ago, dropped down 20, 25, 30%, anyone holding an indexed universal life policy will not be negatively affected because the floor on losses is 0. So the returns won't decrease if the stocks decline, but fees will continue to be deducted, and sometimes those fees can be significant. As a result, the death benefit is not guaranteed. As a result, in my opinion, an indexed universal life policy is not suitable because it's affected by the pandemic, and it's not suitable for any type of offset planning. On the other end of the spectrum, we have a variable life insurance. This is absolutely unaffected by interest rates and is 100% affected by the stock market returns. And as we know, there are no guarantees. If the stock market falls 20%, your losses will result in a 20% loss to your holdings. However, if the stock market increases by 20%, you're not only going to get the 10 or 12% increase, you're going to get 100%. So you get what you're paying for. No floors, no caps, but you are 100% at risk or 100% in the money in the event that the stock market reacts one way or the other. Obviously, the recent drop in the market affected coverage significantly for anyone holding a variable life insurance policy. So because it's affected by the pandemic, it is not suitable for secure offset planning because it is not guaranteed. Whole life insurance used to be years ago that there was chocolate, vanilla, and chocolate was whole life insurance and vanilla was term insurance. Today, whole life insurance is still there and it has a wonderful use. However, there's a time and a place for everything. And the guarantee for the balance, it does guarantee for the balance of the insured's life. And as a result, the policy accumulates cash value. Now, my personal feeling is that one is looking for maximum protection in terms of this pandemic and offset planning. When you're accumulating cash value, you're basically being paid back with your own money. I'm not a big fan of that. Yes, when you're looking at life insurance to be used for living benefit, then it makes a lot of sense. But when you're using it to just provide a death benefit, I personally am not a fan of whole life insurance when it comes to providing a maximum death benefit. For the same dollar, the whole life will provide the least amount of death benefit. It's the most costly type of coverage because you are accumulating funds which can be used at some point down the road. But the duration of coverage is not affected by the pandemic, and as a result, it is suitable for the ACT offset planning. A second to die policy is a wonderful tool, and it pays specifically at the death of the second individual, which is precisely when the funds are needed to be able to offset any type of future tax liabilities as a result of the Secure Act. And this type of coverage is available with all policies with the exception of term insurance. The cost is significantly less for the second to die policy. For example, the cost of $500,000 guaranteed to age 96 for a male 78 is $31,000. The cost for a female age 74 is $18,300. However, if we use a second to die, the cost for both the male 78 and the female 74 drops down to $14,700. Now, again, keep in mind, the beneficiary does not get paid at the death of the first individual. The beneficiary must wait until the second individual passes on and will then receive the 100% of the death benefit. Term life insurance. It's the least expensive cost for the maximum death benefit. Does not accumulate any type of cash value, and it can be guaranteed for 1, 5, 10, 20, or 30 years. But term insurance ends between age 80 and 82. And as a result, it is not suited, it is not guaranteed beyond age 82, and it is not suitable for any sort of offset planning. By the way, just an interesting fact is that less than 2% of term policies that are in force today will ever get to see a beneficiary because 98% of all term policies will expire before the insured that it is insuring. I'd like to spend just a moment talking about today's ability in the insurance marketplace to be able to obtain new life insurance. Like most things, there's good news and bad news. The good news is that it's easier for healthy people to qualify for life insurance. They could do it 100% online. Recently, I've been working with clients online, documents signed online, exams are done online, applications are done online. Insurance companies are spending more quality time doing their own research and making certain that they qualify an individual without a physical examination. They're relying on the individual's doctors, and they're relying on the individual's previous medical records, as well as the questions that are asked by the practitioners over the phone. However, the bad news is that it's become much more difficult for older people to qualify. Here in New York State, we've gone down to 6 companies that are willing to write insurance for individuals over age 70. Previous to this pandemic, the insurance companies would have been more than happy to take applications from people that were in their 80s, mid-80s. If they were willing to pay the premium and if they were healthy enough, they would be able to take the application, but that's no longer the case today. 6 companies willing to write insurance for individuals over age 70, and the amount of insurance that they're willing to write is significantly reduced. The only thing I can say is be honest on the life insurance application. The insurance industry does have a 2-year contestability period where it can and it will question whether an individual, excuse me, whether an individual has been to a hotspot. Whatever the questions that are asked, answer them honestly, because you don't want to be under the misimpression that your coverage is intact and then to have beneficiary find out that that might not be the case and that the insurance industry has dug up some previous information that could be detrimental to your beneficiaries. So be honest on the application. Very briefly, just a few words on annuities. Annuities are now allowed in qualified plans as a result of the Secure Act. For many years, that wasn't the case, but today, annuities are allowed so individuals can accumulate tax-deferred benefits in an annuity. There are 5 different types of annuities. That's beyond the scope of this conversation, so I'm not going to go into them, but I will just talk about the SPDA, the single premium deferred annuity, that is currently paying anywhere from 3 to 5% guaranteed based on the duration of how long you're willing to tie your money up for. Again, the benefit of an annuity is that you can put X number of dollars in there and you will earn whatever the guaranteed rate is. Very few times in the insurance world that I can use that word guaranteed, but annuities are guaranteed. Single premium deferred annuities are guaranteed. And whatever the earnings are during the 5, 10, 15 plus years that you might be holding that annuity, there are no taxes due until the distributions are made. And again, I'll just say that there are tax-free transfers available if an annuity is used to pay long-term care costs. So let's just take a look to see what happens if there's a problem with a life insurance policy. Individuals have several choices. If there's a problem with the life insurance policy, now again, this is what I mentioned earlier, that this is not the insurance company's job or responsibility to tell you what to do. But here is what you can do. 1, you can reduce the face amount. So if you have a $1 million policy and you're paying X number of premiums and you finally find out because you read your annual statement that comes up and you call the insurance company or you call your agent or an independent broker and you say, what does this mean? And he or she explains to you that this means that your policy will not last as long as you think it will. Well, you can reduce the face amount from $1 million perhaps down to $800,000, $700,000. The effect that that will have will lengthen the amount of time, the duration that the coverage remains in effect. Secondly, you can pay a higher premium. If you're paying $1 million for that coverage and you've been paying, I'll make up a number, $10,000 a year, and you find that you have the same problem, another option, if you don't want to reduce the face amount, is you can certainly increase your premium. Instead of paying a $10,000 premium, you might ask your representative, how much more would I have to increase my premium if I wanted my policy to remain in force until age, whatever the age might be. A third option, if an individual is healthy enough, an individual perhaps might be able to qualify for a new guaranteed type of insurance contract. Again, it depends on the individual's health, but if one is healthy enough, it certainly makes sense to shop because, as we know, people are living longer. Modern pharmacology has helped that, forgetting COVID. Modern pharmacology has helped that, and as a result of people living longer, the insurance companies are charging less for new individuals today because they will be collecting those premiums for a longer period of time. Another option is a life settlement. A life settlement, I'll explain that in a moment, is simply a way of selling your policy. Or you could have a combination of the other 4 or 5 items that I just mentioned. So, if life insurance is no longer affordable because of the pandemic, people are unable to pay their premiums. What do? They can do what I just mentioned on the other page. They can increase the premium, they can decrease the death benefit, or if immediate cash is needed to pay for other costs. Again, people think of their life insurance as what's involved in their cash value, but there's a inherent value to a life insurance policy. And just like an individual can sell their car or their boat or their home to be able to raise cash, so too an individual can sell the entire policy. But what do most people do? If they need cash or if they no longer want to pay the insurance premiums, they either give the insurance policy back to the insurance company, called surrendering the policy for its cash value. They get whatever the dollars are. If they made a gain in the policy, there is a taxable event and they will have to pay taxes on any increased gains as over and above what they've paid in. And what most people do is they simply discontinue paying the premium. Very simply. I'm just not going to pay the premium, and however long the policy lasts, they'll just use up whatever intrinsic value is in that insurance policy, and they'll just continue to let the policy pay for itself until one day there's no longer any value, and at that point they'll receive a letter from the insurance company stating, "Dear sir, thank you very much. Your policy is null and void at this point. It's expired," and they'll give you a 30-day option to be able to pay back premiums. But in most cases, that will not happen because the decision had been made a long time ago to just be able to discontinue paying the premium and just letting the policy run its course. But a life settlement provides a significantly larger return. This is a real case that I just finished working on. Male, age 82, had a $3.5 million death benefit. Cash value in that policy was $1.2 million. So had that individual done what the majority of people do, turn the policy back over to the insurance company, he would have received $1.2 million. But by being made aware of the fact that a life settlement is available, filled an application, went out to the secondary market, which are institutional investors, and competitively negotiated for a better deal. And that better deal resulted in the insured, instead of getting $1.2 million in its cash value, instead received $1,875,000. Needless to say, he was very happy. Now, there were, of course, gains over and above what he had paid, and from what I understand, he was very happy to pay those taxes on the gains because he received a significantly larger amount than what he had put in, and a significantly larger amount than the cash value that he would have received. You might say, why aren't more people aware of this? You know, or you might be sitting there and thinking to yourself, you know, that's a great idea. Why haven't I heard about this? Well, there's a case, a class action case by a gentleman named Larry Grill versus, and I'm not embarrassed to say the name of the insurance company, of Lincoln Financial, where a gentleman had approximately $8 million of coverage. He couldn't afford to pay it, set up a meeting with the agent that sold the policy, as well as a exec or manager from the Lincoln National. And they said, what do we do? And the suggestion from the insurance company was, let's reduce it from 8 million down to 5 million. They said, terrific. And they went ahead and they reduced it. They gave up basically $3 million. And then they, unfortunately, the dad passed away. 2 sons kind of came back afterwards and said, you know, gee, why didn't anybody tell us that there was this thing called a life settlement? We just gave up $3 million of insurance on a 82-year-old. I'm told that I could have gotten, you know, that $3 million. I could have gotten a life settlement, and case is working its way through the courts. And at one point, the agent came out and said, well, I wasn't allowed to talk about it because my insurance company told me if I mentioned the word life settlement, I could lose my license. I could lose my appointment, not my license. I could lose my appointment with this company. So the gag order is why many individuals are not aware. Recent Harris Poll study found that of 90% of individuals that surrendered their policy, that 90% said that had I known that there was such a thing as a life settlement, I would have certainly have investigated that rather than just turning the policy back over. So there is a duty, or today, there is a duty to disclose. We'll get to that in a moment. Prior to February of 2020 in New York State, there was not a duty to disclose. I'll talk about that in just a moment. Very briefly, a business interruption update. As we know, majority of business interruption policies, as we found out, excluded virus pandemic. The insurance industry just basically felt that if we ever have a pandemic, now again, this wasn't just written over the last couple of weeks or months. This was written into policies years ago, you know, back in 2008 as a result of SARS. They just realized if there were ever a pandemic, the insurance companies just could not afford to pay out. So the attorneys went to work and they wrote into the future contracts an exclusion for a virus. Now, how many people really go about reading their small print or even large print in an insurance policy? Very, very few. So it caught the majority of business owners who thought that they were covered. And when they went ahead and they put in their claim for financial inability to, you know, make a living or earn money in their store or business, they were told they are not covered. There are movements underway to try to involve the government to reverse that existing exclusion. And again, there are class action lawsuits. And from what I understand, it's possible that there will be some relief for the business owner who was snookered into thinking that they were covered, and they were not. As I mentioned, it wasn't until February of 2020, I'm embarrassed to say, under New York Regulation 187, that the insurance agent was finally held to a higher standard to inform the client of what he or she was buying in writing. Prior to that, there was no obligation to do so. There's still no obligation for post-sale service, which means that if you buy a policy from an individual today, that individual does not have any requirement or any fiduciary liability to come back and ask you next month, next year, 2 years, 5 years from now, how are you doing? And let's take a look and let's review the policy. It's unfortunate, but that did not get into Rule 187, and you are still on your own. It is your responsibility as a insured. And this is something I'm mentioning to the attorneys listening, because if the agent may not be making the individuals aware, and if the owners of the policies who are based, and you sit down with the client to ask about whether or not that policy, that portfolio may have been looked at, may have been reviewed. It's also not necessary to provide an individual with the least expensive policy. You can still have policies that are significantly more expensive, but the new rules, as I say, do require full written disclosure of the risks, and also full disclosure of an agent or a broker's compensation. Just very briefly, the difference between an agent and a broker. An agent is someone who represents one company as a career agent, whereas a broker is someone who is not beholden to that one company, unlike the agent whose office is paid for, whose secretary is paid for, whose health insurance is paid for, whose daily expenses in the office are paid for, whose retirement benefits are paid for. The broker is someone who's independent, pays for all that himself or herself, but they are able, as a result, to provide the client with what might be in his or her best interest, rather than what the particular insurance company that that agent is working for is pushing or is trying to market. Many of the topics that I spoke about today are included in this book that was written 2 years ago, published by the American Bar Association. It's called The Advisors and Trustees Guide to Managing Risk. There are still discounts available, and if anyone is interested, I'd certainly be interested in providing you the information. In closing, there are just a couple of questions that you might consider asking yourself, because again, after all, many of you are insureds as well as advisors to clients. And I'm not going to necessarily read through the list, but suffice it to say that it's important to ask a client the mere question, do you own life insurance, yes or no? There are many nuances to, as we hopefully you may have learned, many nuances to the different types of policies, whether the policy is guaranteed, whether it's not guaranteed, how long that policy might last. Is there still a need for that policy? There's nothing worse than having somebody just paying insurance. There's a problem with being underinsured, and there's also a problem with being overinsured. Many times people bought insurance when they were younger, provide for a mortgage, provide for family income, provide for an educational fund today, or also to provide for business. Today, the children are grown, certainly maybe out of the house, mortgage is paid off, and yet you're still sitting there with that existing policy, and it's just an underperforming, underutilized asset. You might ask, do you still need it? Have they considered a life settlement? Do they provide any type of long-term care protection? There are living benefits to a life insurance policy, and there are death benefits. The subject of living benefits is a whole other topic, but an individual can certainly use a life insurance policy today to pay for long-term care expenses from the death benefit of an insurance policy, tax-free. Very significant. People think of life insurance as just providing a death benefit in the event that somebody passes on, but a life insurance policy today can be combined with paying for long-term care insurance tax-free from the death benefit as a living benefit. The life settlement is also a living settlement, a living benefit. And just very briefly, a third living benefit is something called a SERP, a Supplemental Executive Retirement Plan. Business owners, executives use this all the time, but anyone can use this if they have a excess amounts of money and they've maxed out their 401 or their 403 or their IRAs, but they still have some extra money, they can place that money in one of the accumulation vehicles of an insurance policy and use its tax deferred benefit to accumulate and grow money. And then at the end of the 10, 15, 20-year period, they're able to distribute that money, and they're able to distribute it through a series of loans and surrenders so that the money that comes out is income tax free. Think about that. Being able to put additional money away over and above your 401, 403 limits. You can do this if you're a business owner on a totally discretionary basis. If you're an executive, you can put away additional money. If you're an attorney and you find yourself maxed out on your 401 or your IRA, but you'd like to put additional money away, you can use a supplemental executive retirement plan for yourself. You don't have to do this for any other employee. It's a non-reporting incident. There are no fees, there are no costs. It's just something that you can take advantage of the living benefit of a life insurance policy. Again, there's much more to say, but I see that we're basically close to running out of time. So I'd like to invite Andrea to come back in, and I'd like to open the floor for any questions. And I do want to remind everyone that there are additional resources and articles in the handout section. And I'm sure I'll speak for Andrea when I say that if anyone has any questions, once you read the articles, you can certainly give either one of us a call, email, or telephone to provide additional information or to answer any questions. But since we do have another, whatever it might be, 7-8 minutes, I'd just like to open it up for any questions. And I have 1 or 2 questions for Andrea myself. So let me do that, and I'll thank you. And I will just open it up, Barry, if there are any questions. And while we're waiting for that, Andrea, I'm just curious, what are some common misconceptions that you've seen your clients, the ones that come over the initial reaction of, oh my God, people are dying, what do I do? Are there any common misconceptions that you've found that people have about what's going on today as far as implementing an estate plan?
Well, that's a great question, Henry. Thank you. And I have a couple for you too. One major misconception, and I find it dangerous, is that any attorney is capable of preparing an estate plan, or that a computer program would be sufficient to do it. It's problematic enough that the documents provisions aren't up to date and consistent with what the available rules governing how trusts are managed are compliant with, but they're not executed properly, or the attorney's not a specialist in estate planning, so they don't know what they don't know. I mean, taking a basic class in trusts and estates does not mean that you're going to be writing a comprehensive plan. And some of the important questions to be aware of with titling of beneficiaries, these are things that are very, very important. I think that another misconception is, we've seen it, and I guarantee, I see this commercial every weekend of LegalZoom, and a baby snuggling with a mommy and saying, I love you, and how important it is to create a plan for your family. A computer system cannot replace a human being in the interactive experience of planning. It can ask you stock questions, but that's as good as it gets. So I had a client that did a will by Zoom, had his wife witness him, only one witness. He witnessed his wife's, and he had his brother as a notary. First of all, New York State requires 2 witnesses that have to be disinterested, as well as that notary has to be disinterested. And he said, is this okay? And I said, no. And he goes, you know what? It will have to be okay, because we're in the middle of a pandemic, and when it comes down to it, it will be fine. No, it's not going to be fine. It's not going to be accepted. The will be considered invalidly executed due to a number of reasons, possible reasons like fraud or coercion. So those are some strong ones. I guess the last strong one would be, I'm not a wealthy person, so what I need is just quite quite simple. And while that may be true and it's more streamlined, you still need to have valid, comprehensive documents despite wealth.
Thanks. What should people be doing? Now that the initial shock of the pandemic is here, what should your clients be doing, or what should clients in general, or what should the advisors that are online with us now, what should they be prompting their clients to do?
Well, to have an open discussion. I mean, we can meet by Zoom. People now, we're meeting by Zoom. We're seminaring by Zoom. Have a Zoom meeting with your client so you can have some facial interaction. Pick up the phone if you're not comfortable meeting in person, but have a discussion so you understand what a game plan is so you can get going. There are ways to do this, but by sitting back and ignoring it, the problem does not go away.
All right.
Henry, can you explain or go over why a second to die policy makes sense over coverage on just the IRA holder?
Sure. As a result of the Secure Act, the additional future tax liabilities are now due not at the death of the IRA holder, but after the death of the IRA holder's spouse. So rather than paying a higher premium to insure one person's life when the payout isn't really required until the death of the second, why not take advantage of the custom design of an insurance product that specifically pays at the death of the second individual, and as a result of that, charges a lower premium? So my answer is, pay the insurance company as little as possible and take maximum advantage for your average cost per dollar. And the best way to do that is to buy a second to die policy, which pays out not at the death of the first individual, but at the death of the second individual, which is when the additional future tax liabilities will be due and payable.
Very good. Thank you. So why are so few clients aware of the concept of a life settlement?
Well, the insurance company, as I mentioned earlier, they like when policies expire. And many policies were written over the last 15, 20 plus years through what I call career agency shops. I'm not going to mention names, but they're the ones that you see advertised on TV. They're the ones that you see advertised on TV, and they're the ones that wind up controlling their agents. And when they say you're not allowed to talk about the idea of a life settlement for fear of losing your appointment, they're hitting an agent in their pocketbook. So many agents comply. And since the Rule 187 was not in effect up until February of this year, there was no duty to disclose information to the general public. Many accountants and many attorneys are also consumers. They're not insurance experts, and they were perhaps not aware that the subject of life settlement is even a reality. I was just, excuse me, I was just asked to write an article for the New York State Bar Association, a feature article on the subject of life settlement, and it's coming out in this very next summer issue of the New York State Bar Association Senior Lawyer, in my attempt to try to provide information, additional educational information, to advise the advisor about this subject. But very simply, the insurance companies were not forthcoming. As far as I'm concerned, they were complicit in keeping this information. And the insurance companies make approximately 9% of their revenue from policies that expire. When somebody comes by and offers to buy that policy that would have normally expired will now eventually wind up being paid out as a death benefit. Insurance companies like when somebody pays a premium for 5, 10, 15, 20 plus years and then drops the policy, because the entire premium just falls right down to the bottom line as profits without ever having to pay out a death benefit.
Thank you.
Thank you again for a great program, and thank you all for attending, and have a great rest of the day.
Thanks
Thank
for
you so
your,
much.
thanks for the invitation. Thanks for hosting everything, and thank you for joining us. And thank you, Andrea, for setting the stage. Thank you.
Thank you. Take
Thank
care,
you.
everybody.